Well, hello dragons, and welcome to this instructional video for Lesson 7, Part 4, History of U.S. Banking. The main idea behind this economics lesson is, like money, banking has evolved to meet the needs of a changing U.S. society. With that in mind, by the end of watching this video, you'll be able to describe the views of Federalists and Anti-Federalists about U.S. banking, explain how the development in the 1860s of nationally chartered banks affected the power of state-chartered banks, and describe how the government reformed and regulated the banking system after World War I. Now that the outcomes for this lesson have been shared with you, let's get started. Why might you deposit money in a bank? You probably would do so because you are confident that your money will retain its value and will be available when you want to withdraw it. Consumers like you have not always been so confident about the security of banks, however. The U.S. banking system has had to earn consumers' confidence as it has developed along with the nation. Before the American Revolution, the British government discouraged the establishment of banks in the American colonies. Merchants ran unofficial banks by allowing their customers to deposit their money in accounts and take out loans. These banks were only as secure as the individual merchant's business, however. Establishing a stable banking system thus was seen as a key task for the new nation's leaders. The U.S. monetary and banking systems have gone through three main periods of development. During those periods, banking power has shifted between a centralized national banking system and independent state and local banks. The result over time has been an increase in stability and public confidence in the nation's money and banking systems. The first period of development, from the 1780s to 1860, was a time of experimentation and debate in U.S. banking. During this period, money and banking were part of a larger political battle over the role of government. The nation's early leaders generally considered themselves to be allied with one of two groups. The Federalists believed that only a powerful central government could keep the United States strong. The Anti-Federalists opposed a strong central government and favored leaving most power in the hands of state governments. These two groups viewed the young country's monetary problems quite differently. Although the nation's leaders agreed that the United States needed a stable form of money and a stronger banking system, they disagreed about how to reach these goals. Federalists, such as Alexander Hamilton, believed that a strong centralized banking system was necessary to develop U.S. industry and trade. As Secretary of the Treasury under President George Washington, Hamilton proposed that a national bank have the power to handle the government's funds, to establish and monitor other banks throughout the country, and to issue currency. Anti-Federalists, such as Thomas Jefferson, opposed the creation of a national bank. They feared that the concentration of economic and political power at the national level would weaken the power of individual states. Jefferson supported a decentralized banking system in which the states, rather than the federal government, would establish and regulate the banks within their borders. Hamilton and the Federalists were successful. In 1791, Congress established the first Bank of the United States as a private business. Its 20-year charter, or legal permission to operate, outlined the first bank's responsibilities, which included issuing of representative money in the form of banknotes. These banknotes were backed by gold and silver specie. Additionally, the first bank collected fees and made payments for the federal government. One year later, in 1792, Congress established a national coinage system, and the federal government began to mint gold and silver coins. The government also established the dollar as the official unit of currency. How successful was the first bank? It did bring some order to the monetary and banking systems in the United States. It also was successful in regulating banks chartered by the states. For example, the first Bank of the United States required state-chartered banks to hold gold and silver that could be exchanged for currency. Nonetheless, congressional opponents of the first bank succeeded in voting down the renewal of its 20-year charter in 1811. As a result, the number of state-chartered banks increased almost threefold, from about 90 in 1811 to nearly 250 in 1816. These state-chartered banks adopted many of the powers associated with the national bank. In the absence of government regulation, these state-chartered banks often issued far more currency than they could back with gold and silver. As a result, many of these banks were unable to redeem paper money, causing a loss of confidence in the banks and their money. The chaos in the nation's banking system after 1811 caused Congress once again to establish a national bank. Chartered in 1816, the Second Bank of the United States slowly restored confidence in the banking system and in the representative money that state-chartered banks issued. The Second Bank, however, was not without its critics. Opponents argued that the concentration of wealth in the federal banking system gave too much power to those who controlled it. Other critics argued that the Second Bank restricted economic growth by failing to provide enough credit and currency for the needs of the nation. Still others claimed that it issued too much credit and currency, weakening the U.S. money supply. The Second Bank came under increasing attack after Andrew Jackson, a vocal critic of the bank, was elected to the presidency in 1828. In 1832, 4 years before the official end of the Second Bank's charter, President Jackson vetoed legislation that would have extended it for another 20 years. Jackson's withdrawal of federal government funds in 1833 further blocked the Second Bank's effectiveness for the remaining 3 years of its life. The fall of the Second Bank set off another rise in the number of state-chartered banks. Between 1830 and 1837, the number of state-chartered banks nearly tripled. Because state-chartered banks often issued their own currency, bills and coins varied widely from state to state. For example, in 1835, the government of New York prohibited banknotes valued at less than $10. Some banks, on the other hand, issued notes with values as low as 5 cents. Although by 1830 most states required banknotes to carry round dollar values such as $1 or $5, many people continued to use pieces of dollar bills to represent fractional amounts. In other words, if you visited a store in the 1830s and paid for a 25-cent item with a $1 bill, the clerk might cut the bill into 4 equal pieces and return 3 of them to you as change. In addition to issuing their own banknotes, state-chartered banks issued more credit with fewer restrictions. They also kept smaller and smaller reserves of gold and silver to back the growing supply of paper money. By 1837, people found it increasingly difficult to exchange their paper money for gold or silver. Public confidence in the notes issued by state-chartered banks diminished, and many of those banks failed when they were unable to redeem their banknotes in specie. The resulting economic panic of 1837, however, did not revive public support for another single national bank. Instead, some states coped with the banking crisis by imposing stricter guidelines on state-chartered banks. Most states, for example, adopted the Second Bank's policy, requiring state-chartered banks to hold a specie reserve equal to a certain percentage of the notes they issued. During the second main period of development, between 1860 and 1913, the federal government created a dual banking system made up of state and nationally chartered banks. The system brought more uniformity and stability to the money supply and U.S. banks. This system also meant that the power of national banking increased, while state-chartered banks became less powerful. The fall of the Second Bank of the United States in 1836 and the lack of uniformity among the nation's state-chartered banks created a patchwork banking system during the mid-1800s. By 1861, most of the country's 1,601 state-chartered banks were issuing paper money of questionable value. The Civil War created even more problems for the nation's monetary system. During the war, Congress issued currency to pay the North's war expenses. Called greenbacks, or U.S. notes, the new currency was not backed by specie. Instead, greenbacks were fiat money, backed only by the federal government's promise to repay the note's face value at some future date. The Confederacy also relied on paper currency during the Civil War. These notes were issued by the Confederate government as well as by individual Southern states. This money was worthless by the end of the war, and the banking system in the South was virtually destroyed. In early 1861, 9 of the Southern states had a combined total of 121 chartered banks. By the end of the war, in 1865, no banks existed in North Carolina, Mississippi, or Florida. Only 3 banks still operated in Georgia, and South Carolina had only 1. To rebuild and strengthen the country's banking system, Congress passed the National Banking Acts of 1863 and 1864. These acts gave the federal government the power to charter or officially establish banks and to require banks to hold gold and silver reserves. The government's power to charter banks enabled it to establish a system composed of nationally chartered and state-chartered banks. Additionally, the federal government issued a single national currency through the nationally chartered banks. Unlike the greenbacks issued during the war, this national currency was backed by government bonds. The new currency contributed to the elimination of the many different state bank currencies currently in use. Most of these state bank currencies were good for local purchases only and relied on the strength and reputation of an individual bank for their value. A national currency provided a nationally acceptable medium of exchange and stabilized the supply of money in the United States. With the passage of the Coinage Act in 1873, Congress began reducing the country's reliance on silver as specie. The Gold Standard Act of 1900 committed the U.S. government to the gold standard, a monetary system in which paper money and coins carry the value of a specified amount of gold. A gold standard allows people to exchange their banknotes for gold and keeps the government from issuing an unlimited number of banknotes. Suppose that in 1901 you had U.S. banknotes valued at $150. You would know that you could exchange your paper money for $150 in gold. You would probably choose to keep your paper money, however, because it would be much easier to carry. Additionally, the gold standard ensured that the paper money carried an established and recognized value, so you would feel no need to exchange it for specie. All of these government decisions increased public confidence in paper currency and in the banking system. The system did not, however, provide for an efficient method of regulating the amount of money circulating in the economy. Also, the system lacked any central organization. The third development period in U.S. banking, from 1913 to the present, has been marked by reform and regulation. As noted in Lesson 6, government involvement in the U.S. economy has increased during the 1900s. Specifically, it has focused on regulating the amount of money in the economy in order to stabilize currency values. The banking system has experienced successes as well as failures from this government involvement. In 1913, Congress passed the Federal Reserve Act, establishing the Federal Reserve System, now commonly called the Fed. The Fed became the nation's central bank, and all nationally chartered banks were required to join it. State-chartered banks, however, were free either to join the Fed or to operate as non-member banks. In 2020, more than 3,948 commercial banks including about 15% of all state-chartered banks, were members of the Federal Reserve. In its early years, the Fed experienced both success and failure. The chief success was its ability to provide the government with enough credit to finance the U.S. military effort during World War I. Its major failures were an inability to control credit during the 1920s and a lack of support for the banking system during the 1930s. In fact, the overextension of credit and the resulting borrower defaults contributed to consumer hardships during the early years of the Great Depression. The Great Depression was brought on by financial panic that was swept the nation. Thousands of people withdrew their savings, causing many banks to fail. In the years between 1930 and 1933, nearly 8,000 banks went under, some 4,000 in 1933 alone. Franklin Roosevelt's election to the presidency in 1932 brought lasting changes to the monetary and banking systems. Promising a new deal to the nation's people, Roosevelt sought to restore public confidence in the economy and the nation's banking system. First, Roosevelt kept the nation's bank closed for 4 days in March 1933. The president's order for the bank holiday allowed banks to reopen only after federal auditors judged them to be financially sound. Most banks were reopened within 2 weeks. Certification by the auditors helped restore confidence in the reopened banks, and soon people and businesses began to use them again. Another New Deal reform, the Banking Act of 1933, separated investments from savings in order to protect deposits. Many people felt that bank officials had persuaded them to invest in overvalued stock, destroying their life savings. For example, in 1933, Edgar Brown testified before Congress that he had lost $125,000, in part because he had been pressured to invest in National City Bank stock. After the crash in 1929, the bank had bought the stock back only at 2/3 the price Brown had paid. The Banking Act of 1933 thus prohibited the Fed's member banks from providing investment services such as selling stocks and bonds. The act also established a temporary Federal Deposit Insurance Corporation, or FDIC, which insured each savings account up to $5,000. The Banking Act of 1935 made the FDIC permanent and expanded its insurance for each account. Today, depositors' money is insured up to $100,000 for each account. The Gold Reserve Act of 1934 eliminated the gold standard in the United States and allowed the government to purchase all gold held by U.S. banks. Further, Federal Reserve notes were no longer to be backed by gold. The act also prohibited the use of gold coins and the redemption of Federal Reserve notes at banks. Gold held in the Treasury was used to set up a fund designed to help stabilize the value of the dollar. After the Great Depression, banking practices changed dramatically. Banks began to lend money directly to consumers, as well as to corporations and finance companies. Consumer loans made up less than 1% of total bank assets in 1945, but by 2020, more than 7% of bank assets came from consumer loans. Sales and consumer finance companies, on the other hand, saw their percentage of consumer loans drop from about 40% of assets in the early 1940s to less than 23% by the late 1980s. Some consumers felt that their needs were not met by most commercial banks. In response, during the 1960s and 1970s, a number of banks were established to serve particular groups. These banks, such as Women's Bank in San Diego and Freedom National Bank in Harlem, focused on providing checking and savings accounts, loans, and other financial services to members of specific gender and ethnic groups. Although many of these banks failed, some expanded to offer services to the general population. For example, Women's Bank soon changed its name in an attempt to gain more business, becoming known instead as California Coastal Bank. So that's the way it is with Lesson 7, Part 4, History of U.S. Banking. At this point, you should know that, throughout much of American history, the idea of a central bank has been controversial. Financial panics in the Civil War persuaded Congress to establish a national banking system, and economic reforms of the New Deal gave the federal government a larger role in the banking system. Don't forget to subscribe to my channel to have the entire catalog of economics videos available at your fingertips. Click the subscribe button and then click the follow bell to receive notifications as to when the channel is updated. Thanks for watching, and I'll catch you in class, Dragons.